All right, good evening. This is our fourth class, I guess. So yesterday we started market structure, and I know a lot of you are going to be surprised why I just cut off market structure just like that. Market structure introduction was yesterday, and then liquidity need to come hand in hand with market structure so you understand what is the logic behind the formation of that structure at the extreme. Then I'll talk about the other type of structure. So if time permits today it's going to be the backbone of whatever you're learning. Sincerely speaking, today it's going to be how you understand the logic of whatever you're learning. Not only today, I mean, today is the beginning of you understanding actually how and why the market is doing what it's doing. So let's get straight into the chart. So a little brief highlight of yesterday. Yesterday, I gave an A plus setup, which is the first one. Basically, when you have the start of a storyline, it happens at the end of a chart. I clearly stated when you have a sweep and a break like this, I made an explanation that if this is a daily key level, this particular line is a daily key level. This pattern is on the 4 hour. Immediately you have this break. Then this on the 1 hour, it's going to look like this. Likely, not always. Then you're going to catch your reversal trade, right? That's why I explained. Meaning you're going to have a daily storyline, a 4 hour break, and a 1 hour structure for you to trade it conveniently, the sweep, the break, and the everything. This was the end of where we stopped yesterday because I was trying to blend structure, liquidity. We've discussed key level and structure, so I was trying to blend together the two for you guys, even though we've not talked about point of interest, right? Now, today we are talking about understanding liquidity and market structure. There are basically two type of liquidity. There are basically two type of liquidity. And the first type of liquidity we have the internal range liquidity. Internal range liquidity. And then secondly, we have the external range liquidity. External range liquidity. Now, inside the internal range liquidity, now the internal range liquidity is, let's say, for example, the market is moving. Liquidity, let me just say what liquidity is. Liquidity are turning points in the market. I'm not going to stress you that this is where people are placing their stop loss and the market is going to take out their stop loss. No, anywhere the market turns around, meaning if the market is moving down and the market does something like this, for example, let's say it has an haphazard movement, so many crazy moves. Any turning point, look at this place that is blue. All these points are what? Liquidity. All of them, they are liquidity. Now, looking at this haphazard structure I drew, anyone that is outside the chart is external, and anyone that is at the middle of the chart is internal. What I mean is basically this one is an external liquidity, this one is an external liquidity, this one is an external liquidity, this one is external, this one is external, this one is external, this one is external. But anyone at the middle, like this, all these ones at the middle, they are what? Internal liquidity, right? So now, internal liquidity are the ones that are in the middle of the chart, whereas external liquidity are the ones that are completely outside the chart. And now, talking about internal liquidity, we have two types of internal liquidity. We have couple type of internal liquidity, internal range liquidity. One, we have the structural liquidity. Now, the structural liquidity is used for continuations. I will quickly write it for continuations. Then we have we have the transactional liquidity, which we use for retracements. Then quickly three, we have inducements, which is used for expansion. Then four, or let's say extra, then we have what we call the time-based liquidity. I'll talk about all of them briefly. You're going to get it, right? These are what the type of internal range liquidity. Then we have the type of external range liquidity. External range liquidity. One, we have they are used as targets. Any external range liquidity is used as target. It can it can come in form of trend line liquidity. It can come in form of equal highs and equal lows. It can come in this forms, and it can come as long week what liquidity. When you see the market giving you a very, 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 very long week, right? Now, these are basically the type of internal liquidity, and these are the type of external liquidity. Now, the ideology behind this is that whenever the market take out internal liquidity, right? Whenever the market take out any of these four, if the market take this out, the market is going to target external liquidity next. And when the market target external liquidity next, the market is going to come back to internal liquidity. And when the market take out internal liquidity, the market is going to come down to take out external liquidity next. When the market take out external liquidity, the market is still going to go up to take out what internal liquidity. Now that's the ideology behind this. That's the ideology behind this. Now, let me do it. Let me draw it for you guys. Now, the ideology behind internal and external liquidity is whenever the market take out internal liquidity, the market must take out external liquidity next. Now, let's say the market is downtrending. Let me quickly go to the 1-hour chart. That is why I can draw effectively. Now, let's say the market is downtrending. Now, the market now pulled back. Now, this is an internal liquidity because, or let me just draw so many things. Something like this. And now, now let's take a look at this little diagram right here. Let's take a look at this little diagram. This diagram are cut and join, right? Let's take a look at this diagram right here. Now, if you pay attention, this one was an internal liquidity. The market took out this internal liquidity right here by sweeping this particular high. And if you look, immediately after the sweep, the market dropped down to take out what? This external liquidity. So anytime the market take out internal liquidity, the market is going to target external liquidity next. Pay attention, the next thing the market came, give another pullback, which is in the middle of the chart, which is another internal liquidity. After the internal liquidity, what did the market do? The market came back to target this low, which is liquidity, which is the new target, right? The target of the market. Now, the market now came, give us a change of character or anything you guys used to call it. Now, the market now creates another internal liquidity here. The market came down, take out the internal liquidity. After taking out the internal liquidity, where did the market target? External liquidity. So now, any of this internal liquidity can come in different form. It can come in form of inducement, structural liquidity, and any of them. Now, let's quickly start talking about the inducement and anything we want to call. Now, if you pay attention, sorry. Now, let's talk about structural liquidity. Now, what is structural liquidity? Now, if you guys can remember, let's talk about the structure of yesterday. Our yesterday structure says, if for us to have a valid uptrend move, we need the market to give us a break of structure to the downside and then 2 break of structure to the upside, which is our structure type 1. Now, I'll use this structure to give a lot of explanation. Open your ear. We have a sweep of liquidity towards the downside like this. After the sweep of liquidity right here, we have a break of structure like this. Then we also have what? Another break of structure like this. Now, after we have the sweep of liquidity and then the 2 break of structure to the upside, I will explain each and every move. I said this low was a protected low. Yes. Now, this pullback right here, this first break of structure, this second break of structure, this pullback in form of liquidity is the type of liquidity we call structural liquidity. Okay, we call it what? Structural liquidity. We call it structural what? Liquidity. That this type of liquidity is the type of liquidity we call what? Structural liquidity. I repeat again. Now, this is structural liquidity, this is a protected low, this is a sweep of liquidity, this is a break of structure. Then we expect the market to come back to take out the structural liquidity. And remember, what is structural liquidity used for? Continuation. And remember, it's a type of internal liquidity. Yes. Now, and then immediately the market take out internal liquidity, which is here. What's the next target? External. And this is an external liquidity. And that is why this is going to be the next target. The market is going to come into your point of interest right here after taking out internal in form of structural liquidity to pull up to your take profit. Boom. Okay, so basically, if you understand the whole of this structure, this is a liquidity that was taken out. This was a break of structure. This is now a creation of structural liquidity. This is an external liquidity. This is an internal liquidity in form of structural liquidity. This is a protected low. Markets come back, take out the structural liquidity in form of an internal liquidity. The next target is the external liquidity. Then the market come. Boom. Okay. Now, this is the explanation of yesterday's structure. The whole explanation of yesterday's structure. Now, transactional liquidity is used for retracement. This basically this type of liquidity, we don't use it, but I'll give a brief explanation. So, for the benefit of knowledge, right? For the benefit of knowledge, transactional liquidity is this one right here. This break of structure to the upside. The thing that is present right here is what? Transactional liquidity. That is why after the break of structure, the market retraces. It is used for what? Retracement. What is here? Transactional liquidity. That is why the break of structure, the market will retrace and create what? This structural liquidity. So this one is what? Transactional liquidity, and this one is also what? Transactional liquidity. Right? This one is called transactional what? Liquidity. Then, Oga Pata Pata, this one is my best and my favorite. Now, this inducement is going to take us to structure type 3. Structure type 3. Inducement is going to take us to structure type 3. Now, structure type 3, first of all, let me just define inducement. Inducement is the first pullback after a break of structure. It's the first pullback after a break of structure. Look at it, the first pullback after a break of structure, structure type 3. That's what inducement is, the first pullback after a break of structure. Now, if the market, I want to draw structure type 3, is in a downtrend, let's say the market was in a previous uptrend, and then the market suddenly break down to a downtrend, market will go into pullback and drop. Structure type 3, say, is after this break of structure to the downside. The pullback did not tap on this low, giving us this particular inducement. Then we would be expecting the market to come back, take out this inducement, tap on this low, and sell. This is our inducement. So structure type 3 is solely based on inducement. It's a breaker block structure, right? The market is going to give this sweep. This sweep in this structure type 3 is not important. It can be there as a bonus, but it is not important. This sweep. All you need is what the first break of structure right here, the second break of structure right here. Then this pullback should not tap on this low, making this known as what? Inducement. After the break of structure, this was the pullback, inducement. Then the next thing is expansion is going to come in. If you know and you know my entry model, this is my favorite structure. Abi, this is my favorite structure. Go to my channel, go and look all my trades. Oh, 98% of my trade, this structure type 3. Using inducement. So you can also call this one inducement. That's why sometimes I used to call it inducement. But they said they are not the same, but I feel they are the same. Why? Because this is a break of structure right here. This is a break of structure, and this is the first pullback after this particular break of structure. So this one can also be called inducement, but this is structure type 3 for downtrend. For uptrend, it's going to look like this, like this. Let me drag it to this zone. This is going to look like this, right? This is where the break of structure happened. the pullback after that break of structure, then the market is going to come back to this zone, and this is where the buy is going to happen. Boom. This is your inducement. This structure type 3. This is how it's going to look, right? This is how it's going to look. Now, time-based liquidities deals with Asia's highs and lows, the London highs and lows, New York highs and lows. Now, Asia particularly is the most important one. When you have Asia high or low, there are type of internal liquidity. I'll go into the chart and I'll show you guys all of these things, okay? So you can see how I'm mixing understanding liquidity and market structure. That's why I really needed to mix them together so that market structure is going to make sense, right? So extra time-based liquidity are basically Asian zones, Asian liquidity highs and lows. There are some indicators that people use, but Asia time, I think it starts from Nigerian time, 12 o'clock at midnight to 5 o'clock midnight Nigeria. So the high and the low that was formed during between 12 to 5, they are liquidity. That's why my mentor used to say, Asians highs and lows are never protected. Market must read them. That's what my mentor used to say. He always tell me that Asia high and low are never protected. Market must read them. Those are time-based liquidity. Right? Then external range liquidity are just the targets. It can be in form of trend line liquidity, which is trend line liquidity is basically, let me blend the structures together so some can make sense. Let's say you have a structure for sell, right? Then you have internal liquidity formation. Now, this external liquidity, then you can have something like a long week liquidity or equal lows or equal highs. Anything can be there. Then the market is going to come back, take out this. You can see that, okay, these two lows now are now what? Relative equal lows, like this. Or you can use them as targets. Meaning after the market take out this internal liquidity right here, this internal liquidity, then we'll be expecting the market to come back towards take out this external liquidity. So external liquidity, these ones are not actually something we are supposed to stress ourselves on, right? They are just relative equal. It can be like this self. Then this move is going to be just the same one move like this. Can you see it? But what happened here? Relative equal lows, right? So they are just used as target. Long wicks are used as external liquidity, trend line liquidity also, which is the formation of a trend line, which everybody knows. I don't have to waste my time there, right? Now, those are internal and external liquidity. Now, let's quickly go into the market structure and we can give better explanations. I've already designed USDJPY, so it's going to be used for explanations, easier explanations. Now, let's go to the 4-hour chart quickly. Now, if you come to the 4-hour chart, or let's talk about structure type 3 right here. If you pay attention to structure type 3, or let me just use another one, right? Here's GJPY. Since I'm talking about structure, it's not going to be difficult. Now, let's talk about structure. If you're talking about structure right here, you see structure type 3. Obviously, we have all seen structure type 3 and structure type 1. I've seen them. Now, structure type 3 is we have a break of structure right here, and then we have this pullback right here. If you zoom it out, this is swing structure. Sorry, yeah, this is a swing structure. So the overall, we have a lot of structures inside here, which are on the lower time frame, but this is the higher time frame, right? So the market pull back. You can see, okay, this is where it taps. Okay, then we're using this one as our inducement, right? Can you see it? What happened here? Structure type 3, we have the break of structure here, and we have the second break of structure right here. And then the market pull back after this break of structure. Give us was the first pullback after the break of structure, creating the inducement, and then the sell came here. But if you look at the 4-hour time frame again, this is a sweep of liquidity, correct? Right? This a break of structure, one, this one. This one is one break of structure. This one is what? The second break of structure. And this one is what? Our inducement, our structural liquidity, right? And then this one is structure type what? Structure type 1, sweep break, break. Structural liquidity, buy, boom. Look at this also. Sweep, break, break. Structural liquidity, buy, boom. The same thing over and over and over and over again. So now, why is the market targeting this high now? This one is an internal liquidity right here that the market took out. After taking out this internal liquidity, the next target is this high, which is the external liquidity, and that's why the market came to take it out. Now, this one, now after taking this out, this one become an internal liquidity, right? This one become an internal liquidity, right? So now this now the external the market took out the internal liquidity. I'll be expecting the market to come take out the next external liquidity. It can be this or this low entirely. But if you now pay attention to the overall structure again, we'll notice that this is a sweep, this is a break, and this one is now a structural liquidity for this low to hold. Bam. We are explaining structure, right? So this one can be the external liquidity for this zone, and then this one will be another start of a new fresh buy. So we can go up. Structure. Okay, so the structure I just did yesterday was basically explaining how the market moved from external liquidity to internal liquidity and from internal liquidity to external liquidity. So you understand the structure better after you understand that, right? Okay, let's get into the chart again. Now, let's talk about the final type of liquidity, extra, which is the engineered liquidity. Now, engineered liquidity is not a type of liquidity. It's a terminology, which means formation of liquidity. Now, engineered liquidity is more like the market came, let's say the market want to form structure type 1. Listen very well. Then the market is going to do something like this. Sweep, break. The market has given us the sweep of liquidity. The market has given us the break of structure. But now, let's say you have the POI here. You say you want to sell from here. But the market did not give us that structural liquidity. It's only when the market gives us this particular structural liquidity, that's when we are going to say, okay, this place is going to hold. This place is not going to hold if there is no structural liquidity, right? It's not going to hold. Now, what the market is likely going to do is the market will start coming back, come close to the POI. After the market comes close to the POI, it will not touch it. Then the market will drop. This drop should be at least 50% of this move, of this coming up. Originally, originally, there was no liquidity for this zone to hold. The market will now going to come very close to it. It will not tap it, create an engineered structural liquidity. Listen to the name. That's why engineered liquidity means formation of liquidity. The market will come close to it, give us an engineered structural liquidity. And the market must pull back to 50% of this move for this engineered liquidity to be valid. If the market just pull back to like this, it's not up to 50% of this pullback, this move upward. Then it's an invalid engineered liquidity, except if consolidation happens around here. If consolidations happen around here, then 90%, the market is going to just come, take this out, and then dump. Because it's consolidation that happened. If it is not consolidation that happened, then the market must pull back to at least 50% of your Fibonacci. Then you say, yes, a valid engineered liquidity, then we expect boom. So this is structural liquidity, but it's a what? Engineered structural liquidity. It was not there, but the market just created it so that that zone is going to hold. So there can be an engineered inducement, engineered structural liquidity. Any type of liquidity can be engineered. There will be a POI. The POI is going to be so nice, there won't be liquidity, but the market is going to approach it, come close to it, create liquidity for that zone, and then boom, the buy or the sell is going to start, right? The same thing for structure type 3. Let's say you have like this, a break of structure. Now, you have your zone, and you'll be like, oh, see one bad breaker block where I want to trade. But there is no liquidity. The market is now going to start coming. Come very close to it. It won't touch it. Pull back. Now, if the market did not pull back to 50% of this pullback again, if the market stops around here and then do like this, you go chop yourself. I swear to God, you're going to lose that trade, man. But if the market pull back to 50% like this, then we can take our sell right here. Right? We can what? Take our sell. The only scenario that it did not get to 50% that you trade is if the market consolidates around that zone. Then we'll say, yeah, it's okay for us to just look at this as per manipulation and then distribution. Boom. This one is now what? An engineered inducement. So anything, it's an engineered liquidity. Engineered liquidity is there's no liquidity there for the market to trade, to use, but then suddenly the market is going to create liquidity so that that zone is going to hold, right? Just for that zone to hold. Now, we've said a lot of things. Let's go into the charts. Let's go to the 1 hour. Let's see. This one now is not an engineered liquidity. All these ones are nice, valid liquidities. But this one is a trend line liquidity down here. And this one is a long wick liquidity. Or what we use them as targets. The market is going to target them, right? Let's look for valid liquidity zones. This one, no. Can't find anything. Let's try gold. Let's try gold. Let's try gold. Maybe we can find something. The engineered liquidity and everything. I saw engineered liquidity recently. I don't know where I saw all these things. I don't have this retentive memory anymore. Whenever I see anything, I know where I saw it, but right now it's difficult for me to remember where I saw it. It's very difficult for me. Let me check my trades for the week. There was no engineered liquidity trade. That's the problem. There's no engineered liquidity. All the trades were normal liquidity. This one was a normal liquidity that was there, or it was there already. It was there. This one, the liquidity, okay, I didn't take this. This one, the liquidity was there. There was no engineered liquidity. Okay, but you guys understand the concept of engineered liquidity, right? You guys understand. So the last thing we're going to talk about today is basically the candlestick structure. Okay, the candlestick structure. Now let's talk about the candlestick structure. 3 candlesticks can give you a complete structure. 3 candlesticks can give you a complete structure. Now, what we need for a complete structure is a sweep, a break, and a structural liquidity. Remember, all we need is a sweep, a break, and a structural liquidity. Something like this: sweep, a break, and a structural liquidity. Now, if you have 3 candles listing, you're going to have candle A. Let's say this is a bullish. Let's say this is a bearish candle. Then next, we have a bullish candle. Let's say this is a bullish candle now. Let's say next we now have a bearish candle like this. There's a bearish candle. Then let's say next we have another candle right here. Let's see another candle. Let's say this is bullish. Now, pay attention to all of these candles. I'll try to draw. The candle is so funny now. Don't worry about how they look. Now, do you know that if you go to the line charts, if you go to the line charts, this particular place right here is going to be a break of structure. Do you know? This particular place right here, this sell and buy candle, and then this candle closing below these 2 candles is going to be in form of a break of structure, right? It's going to be in form of a break of structure. Now, if you have a candle formation, I'm drawing for sell, for example, for sell, right? For sell. if you have a formation of candle like this, I try you. If you have the formation of candle like this place is a break of structure. Now, that's the only use of this candle. This candle here is not important. This candle is not important. Let's talk about these three. If you have this candle in form of a sweep of liquidity above this high and a break of structure here, do you know that is the same thing as the sweep of liquidity and this break of structure? This sweep of this previous liquidity candle high and here is a sweep of liquidity and a break of structure. And then this next candle that pull back without mitigating this high is now an inducement in form of liquidity. Then if we come to entry, you understand that we'll now use this to sell the market. And obviously, most of the time, you see the market create a very heavy bearish candle after rejecting from this in form of their POI. Then this candle is going to be a bearish one. The sell has massively what? Started. Just look at this candle formation. I don't do the CM. I don't even sabi draw. Now, wow. Right? I don't know if you guys understand. These candles now, this candle, okay, this particular candle is this high that was swept is a sweep of liquidity. This candle that engulfed this one is a break of structure. This is what we call engulfing candlestick. We'll start talking about them from tomorrow. The pullback that this candle did without mitigating this high is now an structural liquidity. Then we expect the market to come back, tag on this zone, and the sale is going to start. The same thing for the buy scenario. So if this is the 4-hour time frame, and we have a daily key level here, if this particular one is a daily key level, let's say a daily key level. If you have this place as a daily key level right here, then this is an A plus setup. Why? Because you have a sweep of liquidity, a break of structure, a structural liquidity, and you sell. This candlestick structure. How structure happens based on candlestick. Purely based on candlestick. So for buy, I will invert the scale. It's going to look like this. This one is going to be a green one, and this one is going to be a red one, and this one is going to be a green one, and this one is going to be a red one, and this one is going to be what? A green one. The same thing. This is a sweep of liquidity. This one right here, it's a sweep of liquidity below here, and this is a break of structure right here. After the break of structure, this candle pulled back, creating a structural liquidity. Then this low, you buy. The market is going to reject heavily from this zone. This is candlestick structure, structure type 1, using what? Candlesticks. The same thing, structure type 3, you see it using candlesticks. What's going to happen is you're going to have a candlestick like this, a bullish candlestick. Then you're going to see a bearish candlestick. There's the type of entry model I've been practicing recently. Wow, now this one, we have a sell candle, then you're going to have a heavy buy candle. After I have a heavy buy candle, then you're going to have maybe a moderate candle. Usually, it can be any type of candle, maybe a moderate sell candle like this. Then you're going to have this zone. Usually, there's going to be another bullish candle here. Oh, sorry. This ones, all these things I'm telling you, you see them clearly on the line chart. If you go to the line chart, this is going to be maybe another bullish candlestick. So if there's another bullish candlestick, this one is going to be your what? Structural liquidity, right? Your inducement. Then this high is going to be that RBPS you've been looking at, your breaker block or anything you're looking at, right? Right. I'm just trying to draw wicks anyhow. Right, then this one is going to have something like this and then something like this. I will show you guys on chat quickly before the live end. Now this place, this is a buy and a sell candle. This is going to be a break of structure, right? This is going to be a break of structure. Then this is going to be what? Your inducement after that break of structure. Then the market is likely going to give us another what? Massive rejection candle here. The market is just going to tap here and the buy is going to start again. This structure type 3 using candlestick, only using candlestick, a bullish and a bearish candle. Then this one go above, this one create the inducement, and then the buy starts. Just look at this. Screenshot, practice, nigga. Practice. Okay, practice. Now let's quickly go to the chart. This one, I trade it, so I see it happen a lot of times. I trade this one, so you shouldn't be worried. Okay, this is good. Quickly, let's go to the 4 hour. Now let's look at the candlestick. Let's look at just candlesticks. Where did I say this one last? Yeah, this one. This one is this one. The break of structural liquidity. Oh, not this one. I think we need to host another live, or tomorrow we are going to start from this place. We have 2 minutes left. The candlestick structure, you see it's happening a lot of time. A lot of time. You see it happen a lot of time. Just 3 candlesticks, and you know where you're supposed to be heading to. You quickly join the trend and you move quickly. Right? Where can I find it? This one it's a nice one, but the market has not come yet. This place. It's a very nice one, but the market has not come yet. So 30 minutes. So I'll give an assignment for everybody to look for 5-5 for both. You watch the video, you look for 5, you send it. You look for 5, you send it. Right? But if you understand it, you see it a lot of places. I don't know why I'm not even seeing it recently. You see it a lot of places, how the market is going to give you just 3 to 4 candlesticks, and then you need to trade those 3 or 4 candlesticks effectively, and you see how the market is going to give you the exact move. You see how the market is going to give you the exact move. If you can remember, look at NZDJPY on the 4 hour chart. Quickly, I saw one the other day. I traded one week like that. It has passed, but 1 week I traded one. I can't find it. Where is it? I traded. Was it this drop? Yeah, this was it. Yeah, this was it now. This was it. Can you see? Just look at everything quickly. We have the sweep of liquidity right here. Just this candle swept this candle high. And we have the break of structure right here, below this low. Look at the line chart quickly. Look at the line chart. Look at the break of structure, right? The sweep of liquidity, break of structure. The next candle came and did not tag on this zone. This is now my inducement. And this is now where my sell is going to set in. This is what complete structure. This 1, 2, 3, 4 candles has given me the complete structure. The sweep of liquidity, which is this, the break of structure, the structural liquidity, and the sell come from here. So the assignment, everybody should look for 5 candlestick structures for me. Tomorrow our class is going to continue from here. Thank you all for joining, and I'll drop the recording